Merrill Corporation, which uses ASPE, enters into a 6-year lease of equipment on September 1st, 2020 that requires 6 annual payments of $28,000 each, beginning on September 1st, 2020. In addition, Merrill guarantees the lessor a residual value of $17,000 at the lease end. The equipment has a useful life of 7 years. Calculate the amount of the capital lease and prepare Merrill's September 1st, 2020 journal entry, assuming an interest rate of 9%. Round amounts to the nearest dollar. And then B says, assume instead that Merrill follows IFRS and that the amount expected to be paid under the residual value guarantee is $10,000. Calculate the amount of the right of use asset and prepare Merrill's September 2020 journal entries, assuming an interest rate of 9%. So let's start with that. That's part one. Let's just worry about part one for now. So what we're being asked to do is to calculate the present value of the lease payments. So let's start this down here. So part one is calculate the present value of the minimum lease payments. Okay, so let's see what inputs we have here. So we've got what's the term of this lease? 6 annual payments. So we've got 6 is N. We've got I, we're told to assume an interest rate of 9%. Okay, then we've got the payment, which is going to be a cash outflow. So it's going to be negative, and our payment is going to be $28,000. Because right here we've got that it's 6 annual lease payments. Let's see if I can find a highlighter here. 6 annual lease payments, and that $28,000 each. So that's our payment. And the interest rate's 9%, where it says assuming an interest rate of 9%. And then we've got the future value. So how do we deal with this residual value? So one thing that's different about this question that we haven't seen yet is where it says it's a 6-year lease, 6 annual payments of $28,000 beginning on September 1st, meaning we need to make sure we have that begin function on, which we'll need for every lease question. In addition, Merrill guarantees the lessor a residual value of $17,000 at the lease end. So we've guaranteed that it will have a future value of $17,000. And so we want to make sure. Now, why are we putting this as a negative? Usually a future value of 17,000 would be positive. It's because we're guaranteeing that it will have a $17,000 future value as the lessee, and we would have to make up that amount if it's not there. So we put that in as a negative $17,000 because we've guaranteed this future lease payment. So it says, again, it says Merrill guarantees the lessor a residual value of $17,000. So to be conservative, we include a payment of $17,000 as the future value of the lease. And that's only because that residual value is guaranteed. If it was not guaranteed, we would not include it. Okay. Make sure begin mode is on. Okay. And then we're going to put compute present value. Compute present value. And we're going to get 147,047 as our future value, okay? As our present value, sorry. So now we're asked to, so the first thing we're asked to do is say, okay, let's see, using blah, 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 calculate the amount of the lease and prepare Merrill's September 1st journal entry. So we've got the present value of the lease payments. So now we're going to have September 1st, 2020 journal entry. Inception of the lease, or the start of the lease is what that means, is we're going to have debit. Now remember, this is ASPE, so we need to be careful with our terminology between ASPE and IFRS. So we're going to have, this is ASPE, so we're going to have debit equipment under lease, not right of use asset. It's called equipment under lease, and we're going to have this present value of the lease payments here. Then we're going to have credit cash. And this is going to be our first lease payment, which is going to be $28,000. And then we're going to have credit obligations under capital lease. So it's just a different account, not lease liability. We call it credit obligations under capital lease. And this is also going to be the balancing amount, which is going to be $119,047. Okay, so we did that. Okay, and we did the journal entry. Okay, now B says, assume instead that Merrill follows IFRS and that the amount expected to be paid under the residual value guarantee is $10,000. So before we had a $17,000 guarantee, now they're saying it's IFRS and it's only $10,000. And it says, calculate the amount of the right of use asset and prepare Merrill's September 2020 journal entries, assuming a rate of interest of 9%. Okay, so what we're going to do here is now we're going to have, so let's just flag this as ASPE just so we can remember. Okay, and this is going to be IFRS. So we're going to have all these same inputs. Just copy this down. Okay, so the lease term's the same, the interest rate's the same, the payment's the same. Now, remember that the guaranteed now changed to 10,000 from 17,000. We still need to make sure begin mode's on because these lease payments are due at the beginning of the period. And now when we compute our present value, we are going to get 142,873. So it's less because our last payment is less. So up here we had 147, now we have 142. So our journal entry here is going to be debit right of use asset, which is going to be 100, which is going to be this exact amount. Then we're going to have credit cash for our first lease payment, which is still going to be $28,000, of course. And we're going to have credit lease liability, which is going to be the balancing amount. So it's simply the naming of the accounts and the fact that this the residual value guarantee changed between these questions. That's what's driving the difference in the numbers. And the accounts are basically, it's the same entry, but they have different nomenclature. So here we've got right of use asset under IFRS, and here we've got equipment under lease under ASPE. We still hit cash for our first rent payment. And then here we have obligations under capital lease versus lease liability under IFRS. Okay, so I think we finished the first part. So let's move into part two. Part two says, assume that a residual value of $17,000 is expected at the end of the lease, but that Merrill does not guarantee the residual value. Using different options, calculate the amount of the capital lease. Prepare Merrill's September 1st, 2020 journal entry, assuming an interest rate of 9% and that Merrill uses ASPE. Okay. So part two says that a residual value is expected but not guaranteed. Not a guaranteed residual value. Guaranteed residual value. That means that it's not our problem. From the lessee's perspective, we are not guaranteeing it. So if we take these same inputs, then the only thing we're going to change is that now we're not guaranteeing a residual value. So our future value is 0. We are not obligated to pay anything. So still a 6-year lease term, still 9% interest. The payment is still $28,000 a year. And of course, we still have begin mode on, always begin mode on. Then our compute our present value is, we are going to get 136,910. Okay, and our journal entry now, and this payment's a lot lower because there's no payment now at the end of the lease. We haven't guaranteed any residual value. We only include it in our present value calculations if it's a guarantee. So it has to be in the contract. The present value of the lease is the minimum amount or the maximum amount we have to pay as the lessee. So if we said we'll pay it, of course we have to include it. But if we haven't guaranteed it, we do not have to pay it. So our journal entry here, again, remember that we've got ASPE, January 1st, 2020. No, September 1st, sorry. September 1st, 2020 journal entry on inception of the lease is going to be debit equipment under lease. And we're going to have this as the present value. Then we're going to have credit cash as 28,000. That never changes. And then credit obligations. Credit obligations under capital lease. Under capital lease. And this is going to be the balancing amount, which is going to be 108,910. Oh, yes, that's right. Okay, perfect. Okay, so now we did part 2. So we've done 1 and 2. That's awesome. Let's move on to part 3, our last part. This says, prepare a schedule contrasting the journal entries prepared using a guaranteed residual value with those using an unguaranteed residual value. Include in your schedule entries on August 31st, 2020 for the year-end accrual of interest in the lease obligation and the recording of annual depreciation expense using the straight line method and assuming no residual value. Okay. Okay, so basically if we put these side by side, so they want us to contrast here. So contrast journal entries under ASPE, right? Journal entries with guaranteed and non-guaranteed residual. And again, let's just contrast ASPE because most of what we've done is ASPE here. So if we have September 1st, 2020, inception of the lease, start of the lease, whatever you want to call it. So we're going to have, so actually here, let's make 2 columns here. So let's make this guaranteed residual of 17,000, and this is a non-guaranteed residual. Move it over here. Non-guaranteed residual. Okay, so at September 1st, the inception of the lease, which is going to apply to all of this. Okay, whoops. Okay, so that's fine. So hang on, what are we doing? So this is going to be the amount. So we're going to have the residual value. So let's see, what did we have up here? So this is our entry with the guaranteed residual value of the 17,000, remember? So let's put this down here. Okay. Let's figure out how to do this. Let me just fix this. Okay, and then our non-guaranteed residual value we had up here, which was right here, no guaranteed residual value, which is, we'll put right here, which is going to be these values. Okay, so then we've got those 2 contrasted, so you can see how much higher it is with the final payment of the 17,000. This, I think I have an extra 0. Okay, there's our first entry. Okay, so you can see the difference there. Of course, all the accounts are the same, but the amounts are different. The lease payment is, of course, always the same, but our present value of the lease payments is a lot higher when we have a final payment of 17,000 than when we do not. Okay, so then we're going to have the August 31st adjusting entries. August 31st adjusting entries. So we're going to have the first one is going to be to record interest expense on the lease obligation. So what we're going to do is we're going to take the lease obligation, which is this amount, the obligation under capital lease. We know that the interest rate is 9%, which we were given in the question. So that means that we're going to have an annual rate of this amount times 9%, which is going to give me 10,714. So I'm going to have, and same thing here. So let's do the same calculation over here at the same time. So we're going to have this lease obligation, this lease obligation here, and then we're going to have 9% as the interest rate. So this times this. Now let's just check the periods here. So we've got this lease was signed on September 1st, 2020, and this is going to be our December 31st. Let's make sure we make this clear. 2021 adjusting entry, meaning this is actually a 12-month period. Something you really need to watch for is whether you've got 12 months or a shorter period. Oftentimes we have a shorter period in these questions because leases are signed throughout the year, but this happens to be exactly 12 months later. So we're going to record debit interest expense, and it's going to be this amount. We'll round it 10,714, okay? And credit obligation under capital lease, which is going to be 10,714, okay? And same thing over here. We're going to have interest expense of 9801, 9802. And we're going to have credit obligation under capital lease, which is going to be 9802. Okay, so that is the interest expense. Okay, and then the next entry that we're going to have is going to be 2. It's going to be depreciation expense on the equipment under lease. So here we're going to take the equipment under lease, which is this amount. This is a 6-year lease. Remember our N was 6 years. So if we take this and divide it by 6 years, we'll get this much of depreciation per year. We can just round that down. That is our entry there. And over here, same thing. So we're going to take the amount we had under the capital lease, 6 years, divide this by this, and we'll get this amount. And let's just round that down. Great. So this is our annual depreciation, and we're going to record debit depreciation expense, credit accumulated depreciation, equipment under lease. Okay, so here we're going to have this amount and this amount here. That's our credit. Same thing here. We're going to have debit depreciation expense, which is going to be this amount. Credit accumulated depreciation. Equipment under capital lease. Under lease, right? Under capital lease or under lease, it doesn't matter. And then this is going to be that same amount of the 22,818. Okay. And that is the contrast between these two entries. So you can see we had our guaranteed residual here and our non-guaranteed. You can see that not only is the capital lease obligation or the equipment under lease, the asset and the liability higher, or the asset is higher with a guaranteed residual value, and the obligation under lease is also higher. Then as a result, your interest expense is going to be higher, and your depreciation expense is also going to be higher. So guaranteeing that payment at the end of the lease that we included as the negative future value of 17,000 in our present value calculation impacted all of our entries all the way throughout the years. And the fact that there's a non-guaranteed residual means that the lessee doesn't have to make a payment at the end. So that's obviously advantageous and lowers all their payments and obligations. And that takes us to the conclusion of part 3.